Welcome to this explainer. From the bustling streets of Tokyo to the quiet corners of Seattle, we're unpacking a really high-stakes corporate dilemma today, one that pretty much defines the modern business world. We're diving into the ultimate global growth strategy debate, and we're using one of the absolute most recognizable brands on the planet to do it, Starbucks. This isn't just about coffee. It's a cinematic look at the razor's edge of corporate strategy. We're going to explore the intense, ongoing tension between relentless expansion and careful consolidation. Let's get right into it.
So, what happens when a global dominator keeps expanding? It's a fundamental question. Think about it for a second. Does endless, aggressive growth automatically unlock more success, or does a company eventually hit a tipping point where that very expansion risks destroying the core of what made it successful in the first place? For Starbucks, that core was Howard Schultz's original vision of this cozy, romanticized Italian coffee house. But that vision, well, it contrasts pretty sharply with the reality of being an oversized corporate machine today. And that is exactly the strategic tightrope they are walking right now.
80. Really let the sheer, massive scale of that number sink in. Starbucks operates in over 80 countries. We're talking about an absolute empire of cafes, stretching across vastly different cultures, economies, and continents. Just imagine the immense, mind-boggling difficulty of sourcing millions of pounds of beans, standardizing barista training, and somehow maintaining pristine quality across 80 completely different regulatory environments. Managing a footprint that massive is an unfathomable logistical puzzle.
Now, this massive empire wasn't built just on caffeine, right? It rests firmly on three distinct brand pillars: offering a premium experience, delivering consistent quality, whether you're ordering a latte in London or Lima, and fostering incredibly strong customer loyalty. But here's the dramatic twist. Massive growth brings massive new threats. As a footprint expands, markets become totally saturated. Local competition fiercely increases, and holding up those foundational pillars becomes exponentially harder. When there's a store on literally every single corner, that premium experience suddenly starts to feel a whole lot less special.
Part 1. The push for expansion. There are some clear, absolutely undeniable benefits to rapid expansion, and honestly, it's an intoxicating formula for any executive board. First, you unlock entirely new revenue streams. Second, you achieve absolute global brand dominance. Your green siren logo turns into an internationally recognized status symbol that just totally squeezes out the smaller competitors. And third, you leverage massive economies of scale. This means a giant like Starbucks can buy coffee beans, equipment, and prime real estate at rock-bottom prices that local independent shops simply cannot touch. It makes total sense why a huge corporation is heavily incentivized to just keep growing and growing.
Right now, emerging markets, especially across Asia, offer huge potential. We are seeing a massive demand for premium coffee experiences, and it's being driven by rapidly rising middle-class consumers. But this isn't some leisurely rollout, okay? It's an aggressive sprint. We're talking about a strategy of opening a new store every few hours in places like China. It's a frantic race against incredibly well-funded local powerhouses. For a growth-hungry corporation, this looks exactly like a modern-day gold rush, and it's one they absolutely cannot afford to ignore.
Part 2. The risks of expansion.
The breaking point. This is exactly where empires start to crack. First up is market saturation. If you cram too many stores into the exact same region, they just start cannibalizing each other's sales, and that rapidly reduces your overall profitability. Second is brand dilution. Rapid, copy-paste expansion can completely ruin a brand's identity. It's that heartbreaking moment when a bespoke boutique coffee house suddenly starts feeling like a fast food assembly line. And third, operational complexity just absolutely skyrockets. Imagine the sheer chaos of trying to route thousands of delivery trucks, navigate hundreds of distinct labor laws, and staff thousands of new locations across opposing time zones. It is a recipe for total burnout.
Part 3. The case for consolidation.
Consolidation. This is the strategic pivot towards optimizing existing stores, improving operational efficiency, and heavily enhancing the customer experience instead of just expanding rapidly. It's all about looking inward instead of outward, making what you already have significantly better rather than just endlessly acquiring more of it. But make no mistake here, looking inward is a profoundly difficult sell. Try pitching that to investors and shareholders who are basically addicted to the high of endless top-line revenue growth.
So if a company actually hits the brakes on expansion, they redirect all that capital into deep systemic internal upgrades. Take digital transformation, for instance. The Starbucks mobile app practically functions as a massive unregulated bank because of the billions of dollars loaded onto customer gift cards at any given time.
Consolidation means doubling down on those customer loyalty programs so your existing buyers come back way more often. It also means pushing for operational excellence. This is what physically changed the layout of stores, prioritizing frictionless mobile pickup counters over cozy lounge seating. It's all about rebuilding the existing foundation for absolute maximum efficiency.
Expansion versus consolidation. This right here is the ultimate strategic trade-off. On one side, expansion promises thrilling revenue spikes and dominant market share, but it definitely threatens to break the company's operational back and dilutes its prestige. On the flip side, consolidation offers a highly stable, highly profitable foundation, but it requires executives to stomach slower, much less glamorous growth metrics. This is the exact dilemma that keeps global business leaders staring at the ceiling at night.
Which leads us to this critical, lingering question. How do you grow without losing control? Really, how do you satisfy the market's endless, ravenous demand for growth without completely diluting the soul of your brand into irrelevance?
Part 4. The hybrid growth strategy.
Selective expansion plus consolidation. The evolved approach is a true synthesis. They aren't just expanding blindly anymore. Instead, they're taking a highly targeted, almost surgical approach. For example, they might open these massive, deeply experiential reserve roasteries and major international hubs to fiercely protect the premium brand image. But then, simultaneously, they're opening tiny, highly efficient, digital-only pickup stores in fully saturated urban areas. It's totally recalibrating their market presence.
This hybrid approach is a real game changer because it delivers 3 major advantages. First, it allows the company to maintain that essential top-line growth. Second, by pausing to consolidate and refine those older markets, they fiercely protect their brand value. And third, those massive digital investments structurally improve their overall efficiency. Ultimately, this hybrid model acts as the absolute perfect compromise. It brilliantly appeases the Wall Street analysts who demand relentless growth, while simultaneously satisfying the longtime brand loyalists who demand uncompromised quality.
Part 5. The ultimate strategic lesson. Growth is not just about opening more locations, it's about sustaining value across all locations. This entire corporate drama serves as an incredible masterclass for any business, large or small. That quote right there is the definitive golden rule. Scaling a business without implementing rigorous operational control and maintaining your core value proposition, well, that will inevitably lead to corporate decline. Growth at all costs is honestly a toxic myth. Sustained, high-quality value is the only real metric of enduring success.
Is this smart expansion or a sign of overexpansion? So the next time you walk into a Starbucks, I really want you to challenge yourself. Look at the lines, look at the app interface people are using, look at the other independent coffee shop down the street. Ask yourself, through this brand new strategic lens, is what I'm experiencing part of a brilliant, smart expansion, or is it a warning sign of overexpansion? Keep that provocative thought in your back pocket. Thanks so much for joining me for this explainer, and I'll catch you next time.